And with that, we do have some awesome guest speakers that are here today from Ryan Specialty. We have Glenn Hargrove, Managing Director, and we have Carlos Herrera, who is the VP of Diversity, Equity, and Inclusion. So, with that, Glenn, I will hand it back over to you to share your screen and kick off the presentation.
All right, let me get that up for you. Wow, and I see we're international today too. Vanessa from Canada. That's
Yeah,
nice. Yeah.
welcome, welcome.
All right, we're going to let my good buddy, Mr. Herrera, kick this off today. And so, Carlos, the floor is yours.
Yeah. Thank you. Welcome. Welcome, everyone. Hi, everyone. I see some familiar faces on. Hi, Sarah. How are you? And I also see Bernier is on it. And just an FYI for everyone, if you're looking to work for us, make sure that you linked in with Bernier and make him your BFF, your best friend forever, because he has the authority to hire you on our firm. So making sure you say hi to Bernier. We are very excited to be here today. For the longest time, I've heard the greatest things about the Spencer Educational Foundation and how they have the best people like Tandeka and how they have the best students and early professionals involved. So finally getting some time with you is a real gift for me. So I really appreciate you taking the time out of your day to join us. Development and learning is something that is really crucial to becoming successful, both professionally and personally. And showing up today, you're on the right track. So definitely appreciate that. So if we can go to the next slide. So this is who we are. And so as perfectly shared before, my name is Carlos Herrera. But I also welcome Carlos Herrera because not everyone can roll the R's like I can. He, him pronouns, based in Chicago, and I lead our DEI efforts for Ryan Specialty. And then when Glenn does his portion, I'm sure he'll be able to do a little bit of introduction. What I would like to do, there's two things that we'd like to do today, right? First part is me, and I like to give you some insights into DEI, diversity, equity, and inclusion at our firm, because inclusion is a company value for our firm, and it's important to us. And a company's value is pretty much the DNA of a firm, so we want to be able to share that with you. And then after that, the bulk of this presentation is going to be Glenn, and he's going to share the great knowledge that he has regarding the excess and surplus lines. Um, you're going to be in a treat with Glenn because he pretty much knows everything about insurance. So he's the best person to know and learn from.
Thanks for
And
overselling, Carlos. I appreciate it.
and,
Yeah.
I'm not gonna lie. If you're playing any sort of insurance trivia, like you want him on your team because you will win. Right before we get started too, I love seeing the chat. I love seeing it active. So feel free to chat away on there, and feel free to use any emojis that you feel fit. So why don't we go ahead and let's get started to the next slide here. And so just starting off with some just key terms, right? So diversity is a fact, right? It's the mixes of all these diverse demographics, and it's very real, right? It's very factual, and it's happening right now. Actually, I don't know if any of you know anyone in like elementary school or junior high, but if you look at their public schools that they're in, like it's very diverse right now. And by the year 2040, people of color are going to be the majority in this country. And really, 2040 is not that far away from where we're at right now. Then we have inclusion. Inclusion is behavior. It's taking all that mix and making it work together. So inclusion is a choice, right? You have the decision on how you act and how you interact with people on a daily basis on the teams that you're on and in day-to-day life. Then we have equity. Equity is a practice, and that's really being fair. That's really giving the opportunity for all. And I think this one is the winner because if you do this right, everything else will come along. And I know recently SHRM, one of the HR organizations that are out there, put a little less emphasis on equity, but I'm here to say that equity is a very strong aspect of DEI. And then the last piece is the engagement piece. That's engagement is a commitment, and this is very important. Everyone can be involved. Everyone has a space to participate. You don't have to be from a certain demographic to be involved with this space. Everyone has an opportunity. And actually, that's where really allies can really come in and really do a lot of good in this space. So that way all allies, all people are welcome. And if you notice, we refer to it as DEI, right? Diversity, equity, inclusion. But on the way it is on the screen, it actually flows better. But we don't use that acronym, right? That acronym says DIE, so we don't want to use that. So we use DEI. So the next slide. Now, for the next slide, this is where what DEI really means at the firm that we're working at. So for the statement, right? The world is changing and we want Ryan Specialty to change with the world. And what we're saying is there's so much change happening, right? Innovation, technology, social media, social injustice, climate change, just all this change. And if you don't change, you're not going to get better, right? So we just want to make sure that we're part of that change. The next aspect is the mission, right? Further evolve a DEI program where teammates can be involved and contribute. And that's what we strive for, right? Everyone has a role, not just the DEI team. Everyone does. It's everyone's responsibility. And again, this is where allies are important. Then we have the vision, an inclusive and equitable workplace where all employees are valued and evaluated on their performance and contributions. That's what we see down the road. Being fair, having a fair opportunity for everyone to do the work that really matters to not only themselves, but to the firm as well. And then we have the purpose, right? Live into Ryan Specialty's value and inclusion. This is why we do this work. We just don't want this value to be words on our website. We want this to be, we want to live by our values. We want to stick by our values because again, those values are the DNA of a company. And then we have the outcome. Have a culture and environment where people can be their best selves and do their best work. And that's really what it's about, right? That's what we want to accomplish. That's why we want people to feel good about being at work and doing great work and feeling good about the work that they're doing. So with that said, we just want to give you a really quick insight into a little bit about DEI at Ryan Specialty, at RT Specialty, and again, the bulk of this conversation, I'm going to go ahead and hand it over to Glenn. And if you have any questions, I'm going to stick around for the presentation. But otherwise, I'll go ahead. I'll pass it over. Thank you for your time, and get ready to learn a lot about excess and surplus.
Thanks, Carlos. Appreciate it. Appreciate it. I've heard that about 1,000 times, this presentation. It's always a little different. So I enjoy hearing it every time. Good job, buddy. All right, let's jump in. So as a brief introduction about myself, I don't have to do that because all of you looked me up on LinkedIn before you got on this webinar, right? If you didn't, you got to get in the habit of doing that. So first lesson today. But I've spent the last 3 decades plus on the operational side of being in the wholesale insurance business, commercial insurance business. I started out producing and brokering accounts. I've led companies, led operations, offices, and have been fortunate to be part of the management teams of several of the top wholesalers in the country. And now, as a part of Ryan Specialty, I head their education programs under the banner of Ryan Specialty University, which is what I always wanted to do. Was sort of the last chapter of my career, and so I am thrilled to be part of that. This is all of our internal training operations within Ryan Specialty, and external, like doing events like this for Spencer. So let me get started. I'm going to talk about excess and surplus lines today, and just a couple of terms and overviews of what we're going to talk about, just so it makes sense. And you guys, please jump in and ask questions, because I normally do this presentation over a couple of hours when I do it internally for people, and so we're going to be flying through it today. So if I mention something or a term or anything you want to ask a question about, stop me while we're going. So a couple of things. Excess and surplus lines market. We're designed to protect the insurance marketplace and insureds for high risk and tough placements. That's why we exist, and we'll go into that in more detail. A couple of terms, if I use some of these interchangeably, just to let you know, they all mean the same thing. So surplus lines is excess and surplus lines, are called E&S sometimes, or non-admitted or non-standard. And all the insurance that is licensed and regulated by the states, their forms and their coverages is the admitted market or standard market, means exactly the same thing. So just if I interchange some of those terms, don't want you to get confused or thrown off. And then the other thing we're going to talk about today is really the distribution process. So who are the players in a normal excess and surplus lines transaction, and why are they there, and what do they do? And so in this bottom diagram, the simplest of an insured transaction is an insured going to an insurance carrier. And then when it gets a little more complicated, then they get the advice and have a retail agent or a broker that they can work with that will advise them and go to markets. And then if it's a particularly tough risk, then they will bring in the excess and surplus lines market, typically through a wholesale broker like ourselves, like Ryan Specialty. And RT is our wholesale brokerage operation within the banner of our parent company, Ryan Specialty. So let's dig in a little bit. So why does the ENS exist? It's not designed to compete with the standard market. We're designed to really complement it. I think the best way I can illustrate the worth and the value of the excess and surplus lines market is if you guys, some of you are really young, you're not going to remember 2008, but some of you actually do. So the 2008 financial collapse in the marketplace, and that was all about the finance industry bundling these mortgages, and there was some really bad mortgages that were bundled in with really good mortgages, and they were all in one big package. And when they started to uncover this, they realized there was a lot of bad apples there and the default rates, and so the market really collapsed. In the insurance marketplace, throughout its history, we've never had that kind of a meltdown in our side. And I really think part of that is because we have an excess and surplus lines market. So we take those accounts that really need to be treated individually and contain high risk and are unique and separate them. We deal with them differently, and we have experts that are able to deal with those and write customized coverages for them. And that allows, it's good for the standard markets too, the Travelers and the State Farms and that of the world, because it allows them a marketplace to feed that stuff off to, and they can maintain a book of more homogenous, predictable type accounts and risk. And so that adds, I think, a massive amount to the stability of the insurance industry. Therefore, because we can do that, we're often an innovator for new risk. Anytime there's a new technology, new coverage, things out there, it usually comes through the surplus lines market first. And we'll talk about how we have the ability to customize and why we do in a bit. But early on, the surplus lines market got a little bit of a black eye and was kind of referred to a market of last resort, and that it was unregulated and all that. Nothing could be further from the truth as to how it's evolved today. We're an integral part of it. We are highly regulated. Financial strength is amazing, and so it really is just an integral part of the business, and it's grown immensely. And I'll show you a couple of charts so we don't have to read the text on that. So how do we accomplish this? A couple of things. First off, some people will say that the excess and surplus lines market is not regulated. Not true. We are regulated. Our insurance companies are regulated. The brokers are regulated. We've got laws, and we've got state insurance boards and insurance departments that regulate the heck out of us, just like they regulate the admitted market. So it's not an unregulated market. But the one thing that we do have distinctive from the admitted market, in the admitted market, if you want to write a coverage in a particular state, you have to go to the state, file the forms that you want to use, the coverage forms and the endorsements, and you have to file the rate charts for what you're going to use to charge for that particular risk, and then the state will approve it. In excess and surplus lines, we do not have to do that. So that allows us the ability to, or if you think about a particularly complicated or difficult risk, it allows us to formulate the specific coverages to adequately address that, and allows us to formulate the rates individual to every account. And a lot of that stems from the classes of business. If you think about, if we were going to write insurance and we were putting up your money for it, and we were going to do, let's say, a flower shop, a florist in a typical place there, you could pretty much come up with a rate with a few minor deviations, and you're pretty much going to be consistent for it throughout. You can write a bunch of them at the same. So that's the admitted market. If you think about, we're going to write a roofer, a roofing contractor. None of those guys are the same. Some of them are out doing hot tar work. Some of them are out doing huge commercial buildings. Some of them are doing residential. Some of them hire uninsured subcontractors, which makes it really difficult. And so there's a need to be able to specifically address the rate and the forms to each individual account. Therefore, a lot of roofing contractors, the vast majority of them, end up in the excess and surplus lines marketplace. And that's just an example of a typical type risk. The other thing that's out there important to note, state guarantee funds, which will guarantee payment in the event of failure or bankruptcy of the insurance company. There are state guarantee funds attached to admitted policies. They're usually fairly small limits, 100,000, 300,000, that kind of thing. Those don't apply to excess and surplus lines. But the good news is, if you look at the overall strength of the carriers, as far as the financial strength of them, E&S carriers are on average in better shape than the admitted market. They're required to have more capital, and they're generally financially in really good shape. We've only had one default over the last 10 years in the excess and surplus lines market, where every single year we will have defaults on admitted carriers, particularly after a hurricane, and you see a whole bunch of little small Florida property insurers that are admitted go bankrupt. We don't have that as much because there's tougher requirements on our excess and surplus lines capital that we have to supply. Captive agents, another difference. Admitted markets will actually, captive agents means they are owned by or franchised by the parent company. So like you will see Farmers Insurance agents, you'll see State Farm agents, those that are out there. So admitted markets have captive agents, and excess and surplus lines markets do not. Just as the number of carriers that are out there, 762 on the admitted side, 161 surplus lines companies or groups. And the premium as of 2020, I need to update this a little bit, but because it's grown in proportion, but 728 billion in the commercial, this is all commercial, not personal lines, and the admitted side, and 66 billion on the E&S side.
So you do have a question in the chat box, Glenn. So Vanessa has a question. Actually, Vanessa, if you feel comfortable enough, do you want to unmute yourself and ask?
Yeah.
Sure. Hey, everyone. Hey, Glenn.
Hey.
Really great example with the roofing. I think that really helps paint a picture. Can you give a few more examples of the most common types of risks that are covered in the E&S market? And then totally different, what's the wildest, most out there thing that you've seen covered in your career? Maybe when you talk to those emerging risks or newer, so you don't see very often.
Sure, absolutely. So the common things, if you think about, so let's talk about property insurance real quickly. Property insurance, the stuff that's really hazardous is things that are going to have windstorm. So hurricane zones and hurricane areas by location, earthquakes. So California, the New Madrid quake faults. So earthquakes push property into surplus lines. And what we've had here where I am in Dallas, Texas, the North Texas convective storms of tornadoes and hail and that. So property, you're usually looking at weather storm damages of why it would get pushed into the surplus lines market, or really bad construction, so older construction that's tough to do, a lot of large scale frame stuff that's basically just a tinderbox waiting to happen, those kind of things get pushed into surplus lines. From a liability standpoint, it's things that just have really great variety. So, so a lot of products that can cause injury or death, so nutraceuticals and pharmaceuticals and medical devices and things like that, critical parts to automobiles and those kind of things go into surplus lines. And then there's a whole area of professional lines, so coverages for errors and omissions for professionals, all the way from medical malpractice, from doctors to lawyers to accountants to any kind of professional liability, and directors and officers coverages, cyber coverages. A lot of that goes into excess and surplus lines. So that's very typical. Wildest risk, I think recently, as far as the ones that I've worked on, I worked with one of my brokers a couple of years ago, and we insured the Dead Sea Scrolls while they were on tour in the US and being displayed. And that was a wild risk, because how the heck do you value them? So from an insurance company, it's like, okay, what's the valuation? There is none, because it's obviously priceless. And so we had to work with Lloyd's of London, and these things were stored in a vault in Zurich, and had to have some expert that they found that could go assess valuations and assess how to transport them, because these particular pieces had never left this vault, and do that. And so, the coverage was fairly simple, but the all that we had to do to put it in place and come up with terms was pretty wild. So that's one example of something kind of extreme that's out there. And we do deal with all the emerging risks. So we're all talking about autonomously driving vehicles, and what are the latest things of, what's the next coronavirus that's going to happen, and all that sort of thing. So lots of novel risks. Great question, Vanessa. Appreciate it. See another here from Brian. DPSL, direct premium surplus lines groups. So sorry for throwing a weird acronym on the chart there for you, but that's just the groups of companies, the parent company groups of surplus lines carriers. So we talked about growth, and this really illustrates it. So most of the recordings are broken down into four basic categories. Of the domestic professional, that's just your typical surplus lines insurance company. And then they usually show Lloyd's, illustrated by the red line here, separately, and regulated aliens, which is any foreign company that insures in the U.S., excluding Lloyd's. And the bottom is a domestic specialty. That's those are association type programs. So I won't get into that, because that's a 20-minute discussion in and of itself, and it represents a pretty small area. Anybody want to guess what the number one regulated alien country is that produces business back to us, if you take Lloyd's out of the mix? Nope. Canada. You guys, waving the flag. Mexico. Nope. Bermuda. So most of those are Bermudian insurers in there. That's the biggest bulk of that. I don't know why it's not Canada. You guys need to have more insurance companies in Canada that do business here. So the other thing that affects the excess and surplus lines market, maybe even a little more than the regular market, is the hard market and soft market cycles. So just so you understand the definitions of those, typically a hard market is when we have rates climbing and coverages are being restricted. And in short, it's usually just because the insurance companies think that they are undervaluing what they're doing, that they're potentially losing money. All the insurance companies have to project what those policies are going to do over a period of time and forecast it. And when they're looking in their crystal ball, if they feel like that they potentially could be losing money on those coverages because how the claims are developing, and what's happening with it, then they'll want to move into a hard market and let's charge a little bit more. Let's get a little tighter on our coverages. So the things that can push that are economic conditions overall, catastrophic events, On the casualty side, any kind of change in laws in a particular state could make it particularly more litigious for a particular loss. So those kind of things affected, and then obviously big catastrophes like 9/11 had a huge spike on the business. It was really short-lived, but a very huge spike on the business. COVID did, even though it softened the activity. So some premiums came down because it slowed the operations and the economic development in the country for that period of time during the shutdowns, but definitely added a new element of risk that a lot of people hadn't considered how severe it could be. And then the opposite of that's a soft market where the companies feel opportunistic that they can go out and gain market share, lower some premiums, write more accounts, get a little more flexible on their coverages. And it's simply them being positive about what they think their results are going to be and thinking that the market's a little overpriced. Typically, the insurance market, we tend to overreact in both of these circumstances. When it's going into a soft market, we tend to get too cheap and overestimate that and get caught up in it. And when it's a hard market, we tend to get too expensive and don't correct as quickly as we should, but definitely happens. All right. So another example of this is the growth in excess and surplus lines throughout these years. And you can see the 9/11 spike there in 2002, which was just huge. Through a lot of business in the surplus lines market. As much as anything, that was really a panic a panic by the standard markets that they threw a lot of stuff into surplus lines because they just didn't know how to deal with it. So we grew immensely there. Yeah, we do see, and to answer the question, there is some parallels to the stock market here. If the market's doing well and economic conditions are doing well, there's opportunities for more business, and you can get more aggressive about it. After that, what I talked about, the 2008 collapse and the financial downturn, we lost, but the overall marketplace lost, and we didn't lose as much during that time period. So I'll show you that on the next chart. And then we've rebounded nicely, and 2021's grown. And if I did 2022 and 23 on here, those would continue up at the same kind of a trajectory as what we've been on. It's been a terrific time for the excess and surplus lines marketplace. This shows you a little bit different on the graph. The overall marketplace is the whole bar graph. And the top part, the little lighter turquoise, is the surplus lines portion. So you can see in that 2008 to 2011, the whole marketplace dipped. But as the purple line illustrates, the percentage that surplus lines is of the overall commercial marketplace, we didn't dip as much. We still stayed very constant, and we've had a really terrific growth really since 2010. And it's been a heck of a ride. So we'll talk later about whether that continues or goes forward. Couple of other things to know about surplus lines. The licensing is done, and regulations that we do have are done separately and a little bit different than the admitted market. It's all done by individual states, which makes it, as is most insurance, which makes it very complicated because you can write multi-state risk, and sometimes you can have laws that are conflicting in various states. And so how do you handle those? So important to know, and all individuals that are involved are licensed by the states that they do business in, their resident states, and then they're able to obtain non-resident licenses in those other states. One of the things that's unique to surplus lines, when it was originally created, the states said, okay, fine, you guys can do this, and we won't regulate your forms, and we won't regulate your rates, but we're going to make you as surplus lines brokers accountable for what happens on that. So there are separate excess and surplus lines licensing for E&S brokers, And we maintain a larger degree of responsibility legally than what a retail agent might for the placements. It's why we buy errors and omissions insurance in case we screw up or we give bad advice. We're relied on as being the experts in that area, and a lot of the laws push that to being our responsibility as excess and surplus lines brokers. And the tax policies. So admitted policies, if you look at the cover or deck page of an admitted policy, it won't show taxes on there, but the taxes are paid. They're included within the premium, and the insurance company, the admitted market, pays those taxes. On surplus lines policies, we actually show the taxes separately, and it's broken out separately, and we pay those through the various states, organizations. We may have policy fees, other things that are out there. The really large surplus line states, plus a couple of others, as you'll see from the map here, have what's called stamping offices. And those are merely independent regulatory offices that monitor the surplus lines premium, what kind of business they're writing. And, you know, you can see the big states: California, Texas, Illinois, New York, Florida. Those are the big five. And some of the others. So we get a lot of our data on what's going on with surplus lines from these stamping offices. They're actually a huge help to us. So even though we're not always thrilled with regulators, these guys are good guys to us. We work with them pretty closely. So let's talk about how these products are distributed and who has it. So who holds an excess and surplus lines license? We can act, it's wholesalers. When I say wholesalers, we are a group of several of these functions, as we are at Ryan Specialty. But we operate as a broker, first off, which means that we don't have any authority from the insurance company. You bring a risk to us, we go to an insurance company and we negotiate a deal, and hopefully we've come up with a good deal, and we bind it and write that coverage. But it's strictly us negotiating on your behalf. In some cases, we act as an MGA, which stands for Managing General Agent. And in that case, the insurance company has come to us and given us the authority to actually quote and bind risk, as long as it falls within a certain parameter, certain box. You know, the account size is such, it's this classification, they've been in business for so long, whatever their rules and regulations are, and they dictate that and give us the authority to be able to do that. Typically, that's going to be on smaller risk and things that are a little easier. As we get a little closer to what standard markets may write, that's generally will fall under the MGA, whereas really difficult big placements and all that, those are going to be brokered. The insurance company is not going to be willing to turn over the authority for that. Closely related to MGA is something called MGU, which is a Managing General Underwriter. Really, that's a delegated authority too. So the insurance company's given us the authority to quote and bind. But the only difference really between those two is typically under an MGU, the broker has come up with the program, developed it, and gone to the insurance company and said, will you underwrite this? And they agree to it. Whereas on the MGA side, it's the insurance company's program that they've given to us. So on the MGA side, they will have usually given those authorities out to several wholesalers. A lot of our competitors may have that same authority. On the MGU side, those usually are exclusive and something that we've developed and put together, and or any other wholesaler that has an MGU operation. Program manager is just a type of an MGU. Same thing. But typically will involve really narrow classes of business. So real specific things. And like we've got programs for marine business and oil and gas and cyber and transactional risk and that. And they may have multiple coverages that they have the authority for. And those guys are true experts on their specific niche in the marketplace. And some of the larger retailers hold excess and surplus lines licenses too. So some retailers can go to excess and surplus lines carriers and write excess and surplus lines without involving us as a wholesaler. Not that we like that, but we have to, but it keeps us on our toes. We have to sell our value proposition. So, I don't want to go through all these specifics on here, but because a lot of that's pretty obvious. But basically, our value proposition as a wholesaler is a couple of different buckets. One is access to markets. So we're an aggregator. If we can tell a retailer, if you come to us, you can make one submission to us and we can go to 50 different markets for you without you going to 50 different markets and get quotes from all those people and bring them back to you. So we've got that sales pitch as an aggregator. We also have that same sales pitch to the insurance carrier, that we offer you access to 40,000 retail agents just by having a relationship with us, as opposed to you going out and building those. So there's that aggregation role. Second area is expertise, because we're dealing in very, very narrow market focused areas. Oftentimes our brokers that are involved in that are the smartest guys in the room on that industry and that class of business and the coverage. So we offer that expertise to the retailers. And then the other side is just outsourcing. We're pretty efficient at a lot of the things that we do. So there's a good argument for a lot of the people that utilize us as an outsourcer of the goods and services that they're doing. So if you look a little bit at our company, this kind of outlines how the different risk would function and flow. So I know it looks like a complicated chart, but it's not terribly. So an insured comes
Not
in and
complicated at all. What?
No,
It
it's
doesn't look
easy.
complicated. What?
This is easy. So we start with an insured, that's basic, and then they go to a retail agent, and they can, just as the top line size, go straight to an admitted carrier, and they're done. Easy. If they come to a wholesaler, then we break it down into really 3 operating units for us: wholesale brokerage, underwriting management, that's MGUs and programs, and binding authority, that's MGA. And the type of risk that would go to that, obviously on the broker side, really large, tough, complex things. I hate the word bespoke. I don't know why we have it on there. That's become the latest corporate speak. Every presentation you have, people use bespoke. I don't know. I think it's getting worn out already. But brokerage, if it's smaller, larger type risk on the underwriting management side, but really specific to a really unique industry that contains a lot of unique coverages, that will go into an underwriting management bucket typically. And the smaller transactions go into MGA and binding authority type business, or even electronically transmitted type business as well. And all those can go to an E&S or a specialty carrier. So really, it's really not as hard as it looks. So we talked about really when to use it by what our value proposition is, but our role with both our relationship with the carrier and our relationship with the retailer is really to provide the service and expertise to facilitate the transaction. We want to make that pipeline as smooth as possible. We want to add value wherever we can. If we are just exchanging information, we're not really doing anything. So we pride ourselves on being able to be, I talked about bespoke being a rare word, and then I said pride ourselves on. That's trite too, so sorry. If we're not adding value to the risk, if we don't improve the quality of what happens because we're involved in that transaction, we maybe shouldn't have been involved in the first place. And so we're always looking to improve that. And I would say that for the whole excess and surplus lines wholesaler marketplace. That's not just Ryan Specialty, but every wholesaler always looks at, how am I adding value? How am I creating a better experience for the insured, for the retail agent, and for the carrier in this process? So what does this look like going forward? I talked about that trajectory of things going north for us and the excess and surplus lines marketplace getting more and more complicated and growing. I see that as nothing but increasing, because we've got so many things going on in our world. It's complicated out there. We've got everything from new inventions. I talked about like autonomous cars and what's going to happen next. What's the newest thing that's going to come out? Just trying to keep up with cyber liability coverages with all the technical stuff that goes on in that side of the world, is super complicated. And excess and surplus lines is always on the cutting edge of how we're developing products for that, and how we're dealing with those issues that are out there. I mean, one of the things, as an example, on the cyber side, when we first started out, to give you an idea of how it evolves, the first concern was sharing private data. That was the big thing. It's like the Target deal, and you got everybody's credit cards, and people are going to get their social security numbers and sell them online. Okay, that's a big exposure. We'll start to cover that. But that kind of died down, and most people's protections got okay, and that hasn't been the big risk. Then it's turned into more of what it is now, which is extortion. It's ransomware, and it's shutting people's systems down and demanding fees in order to release files or not crash systems. That's it. The one that's on the horizon, which scares the heck out of everybody, is what about cyber terrorism, and how do we cover that? So when they get to the point, like that ship that hit the bridge in Baltimore, is that, what if that would have been, or might have been, who knows, but, somebody hacking into their system and driving it into the bridge? What happens if somebody takes over a whole a slew of autonomous Tesla cars and drives them all into buildings? Who pays for that? And what happens? So the evolving risk through a technology standpoint, huge. There's always changes in laws and litigation. Companies our politicians always want to lay the blame on businesses and try to make them liable for things. And so, those are changing and have to be covered by insurance as much as possible. Active shooters, global warming, nuclear verdicts. I mean, there's just so much happening that the need for the excess and surplus lines market in the insurance industry as a whole is massive. And it's why I love it and have enjoyed being a part of it throughout my career, because it's always different. It's always, you have to really think through things and analyze things. Nothing's standard, nothing's routine, and nothing's ever the same as you move through. So I love being a part of it within our industry, and I think I would have been bored, frankly, if I would have been a personal lines underwriter or something like that. I don't know if I could have handled that. So I think it's such an exciting part of the business, and will continue to be an ever more important part of it. All right, man, I ripped through that really quick, and probably didn't cover a lot of details. So I would love to open it, stop sharing my screen so I can look at your faces again, and would love to open it up for questions for either myself or Carlos, and jump in and ask what you want. You guys did some really good ones on online. So I'll see
Yeah. And there is a question in the chat box from Yagna. I know Yagna's dialing in all the way from India, so she's probably not in a space where she can speak right now. It's like 10 or 11 p.m. over there. But she's asking, how does a wholesaler handle a situation where retail broker's client has very specific or unusual coverage needs?
Yeah, I think first off, hopefully we're an expert in the industry. So that's the biggest part that I think that we offer, is that we know the industry that insured's operating in inside and out, so we can understand, and we'll go back to the very basics of analyzing what the risk profile is. It's what could possibly happen, and when that does happen, how are your other policies going to respond, and where might you have holes or gaps in your coverage, and how would it be best for us to address that? Are there existing policies that we could modify or endorse to cover over those holes and the gaps? Or Are there other, or do we need to create or find an existing policy that's standalone that would cover that? Or is it something that's really uninsurable, but maybe we need to finance it for you? So that's where we get into alternative risk coverages, where we can do a lot to offset your own self-insured exposures there when you get super, super complicated. I mean, some of the things that we've worked with recently where the coverages are getting really tough and there's alternative coverages. A lot of it revolves around cyber currency, the cryptocurrencies. So there's a lot of really unique exposures and risks that are very tough to quantify and almost uninsurable. So we create financing mechanisms for them in order to be able to do that, and typically called alternative risk. So let's see what we got here. Alon, you're going to ask me another question? You had 6 weeks to ask me questions in class, man. Now you're going to pop up and ask me another question. Good to hear from you, buddy. The future of the E&S market look like once the hard market cycle ends? Well, the funny thing is that I don't know that we're going to have the traditional hard market, soft market cycles going into the future like we've had in the past. I mean, before, the entire marketplace would move towards a hard market and then it would move towards a soft market. And I think one of the things that's happening now is that the insurance companies are becoming a lot more sophisticated. They've got a lot of big data and things like that to be able to analyze. And so we're seeing segments of a marketplace get hard and go into a hard market while other segments are going into a soft market. So I think there's always going to be unique opportunities that are out there as you go forward, that are there. But one of the things that happens if you move into a soft market for us on the wholesale side is we get really creative on distribution. And how are we going to streamline that? How are we going to automate things? So when we're not focusing on innovations and coverages in a hard market, we focus on innovations and distribution platforms and things like that too. So I think there's so much room for us to grow and get better on the wholesale side that there's plenty to do. How do insurance companies...
Thanks, Glenn.
You're welcome, buddy. You knew the
Great
answer to
shirt,
that. You
by
just
the
wanted
way.
to answer it. You just wanted to ask a question. I'm going over there. So, Vanessa, how do E&S companies spread their risk? Reinsurance, reserving, absolutely. So, reinsurance, huge part of it. So, reinsurance, they can buy, for those who don't know, insurance contracts to insure their book of business, or they can, and that's called treaty reinsurance when they're insuring a book of business to partially offset the potential losses that they may have in that, or they can utilize facultative reinsurance, which is on an individual risk. So not on a book, but on an individual risk. And they can utilize facultative reinsurance to lay off individual big risks that are out there. So they'll do that to spread their risk, number one. Number two is that on the E&S side, particularly, and the best example of this is in Lloyd's, where you can share risk with other insurance companies. So on a Lloyd's policy, Lloyd's is not a specific insurance company, it's 60 of them all together. And on a Lloyd's policy, they will each take individual shares of a risk. So they do a great job of being able to lay off the risk by only taking a percentage of a layer or loss. And then you see that on the property side. Excuse me. On the property side as well, where you see quota share property deals, layered property deals. It's all about that insurance company shrinking their line of business, but still staying on the risk to help control their exposure. So a lot of different ways.
These are fantastic questions. Any additional questions? And thank you so much for explaining all of this to us, Glenn. These are like really complex topics and concepts that you're able to just break down in a really digestible way. So thank you for that. Oh, looks
absolutely.
Like there is a question. Chirag, did you want to say hi? Do you want to unmute and ask you a question?
Hi, am I audible?
Yeah.
Okay. First of all, thank you so much for this session. It has been super insightful. I'm a little new to the insurance industry, and this is the first time that I'm actually going through ENS. I traditionally have a technology background, so all of this is fascinating. I wanted to understand how one can break into this industry because all of your work is so exciting. Where does one even begin?
Well, fortunately, when you see that chart with that growth going up, it means we all need more bodies too. So, we are always looking for more people and in the whole industry on the excess and surplus line side. So I think it's a matter of getting on and using the good old Google searches and finding out who these wholesalers are and read about them and what they do and where they operate. And then I think it's leveraging the things that you do know. So if you come from a technology background, there's a huge amount of what we do on the surplus line side in two ways you can look at that. One, from insuring technology. So if you're talking about like cyber covers and everything else, you come in with a built-in advantage already because you already know the kind of things that we're covering and the kind of losses that potentially could happen. So great way to sell yourself there. And then the other side is that when that we're looking at technology distribution methods on how we do it, we're trying to build systems to be able to quote and bind and do things online and to be able to transmit the information that we need in order to do this and get more efficient at it. And so there's all sorts of areas there too. So I think that's one of the cool things about our business in the excess and surplus line side is you can take experience or background from almost any area or any industry and then apply it to what we do. So I didn't mention like in my background, I originally didn't start out in insurance. I started out in the oil and gas business, doing energy and oil and gas business. And when it collapsed and I needed a job, I moved into the insurance industry and I was able to broker and do oil and gas business. I didn't know as much about the insurance side, but I knew the industry and I was able to sell myself and get started and get a foothold in the business because of my prior background. So I don't think that because you don't have extensive insurance background, you can't sell some of the attributes that you bring to the table up front as well, and that those won't be appealing.
Thank you so much.
Sure, absolutely. Good question.
I love that. Well, we are right at time. So, Glenn, Carlos, thank you so much for hanging out with us for an hour. For all of the students that are here with us today, I will catch you guys all next month. I'm gonna miss seeing you guys every single week. I really enjoyed spending the summer with you, but good luck with the school semester starting. And I look forward to seeing you. Our next session is going to be September 19th. So it's going to be after our gala, Funding Their Future gala. So I'll have a different background next time we connect. But please feel free to keep in touch, call us, text us, message us on LinkedIn. And Glenn and Carlos, thank you again so much for your time. We'll catch you guys later.
Thanks. Great group. Appreciate it.
Thank you. Bye.